This is your mortgage rate watch for Friday, January the 7th, and I'm Keith Akada with the Mortgage Reel. So it's a mixed bag of reports coming from the job sector this morning, but let's break it down and see how this is impacting interest rates. The Labor Department reported that 103,000 jobs were created in December, which is below the recent expectations of 150,000. The private job growth rate was 113,000, below the expectations of 162,000. Overall, they're still showing signs of a trend of improving labor market. Now, this is where the real shocker is coming from the market and is creating some volatility, and that's coming from the unemployment rate. It was at a previous reading of 9.8%, dropping to 9.4%. Keep in mind that this is the lowest unemployment reading rate since May of 2009. This is all good news for the economy. We've been talking about this delicate balance of what's going on with Wall Street and the economy, but here's what's really swaying. We also mentioned before, and this is the biggest factor, not knowing what's going to happen overnight. And this has to be a very big caution for homeowners and future homeowners out there. The euro right now is still showing signs of instability, and with that comes a lot of skepticism. When the skepticism comes into the market and the uncertainty is there, the U.S. bond market is still the safe haven for the world as far as investments. So those monies come into the United States. It helps the bond market, pushing those yields lower, and this morning it's pressuring interest rates lower. But keep in mind that the euro will not always ail the U.S. dollar. Eventually, they're going to find their way, just the United States right now is finding their way, and things will go back. When that money exits the U.S. bond market, that's going to put a tremendous amount of pressure on interest rates. So as the U.S. economy continues to improve and showing signs of positivity, and the euro figures its way out, once the European markets do stabilize and start to show signs of economic improvement later on this year, as you can imagine, that's a double whammy for the mortgage rates, as we see more and more of quantitative easing 2 come into the market, because still the Fed is convinced that quantitative easing 2 is necessary in order to keep Wall Street going, to keep creating jobs, and also to keep creating inflation. This hypothetical inflation that the Fed wants to create, it's in place. They're creating it. Just look at the cost of energy. Fuel is going to be pushed higher this summer, and that's a clear indication of that. So we just want to forewarn that you have to pay attention with what's going on with interest rates right now, because we are clearly at a point where this could be the bottom. Any breaking news, make sure to follow us on our Facebook page, and below you can leave any type of comments you like. If you find this post today interesting or at least favorable as far as assisting you with figuring out what to do with interest rates, make sure to leave us that feedback so we can make sure that other viewers also find the same. Otherwise, have a great weekend. We'll be back on Monday.